Yo, we're live. I just started the stream by saying, yo, we're live. Hey, it's Mitch Goldberg. It's just a little after 4:30, but they call me Mr. 4:30 because that's like my time slot. No one dares run a podcast or a live stream in my network at 4:30. They know it's me. It's my time. Yeah, listen, you could try. I have to be greedy with the time, right? It's valuable. It's your time. It's my time. We're talking about just a crazy market today. And I think a lot of you are really interested in the market. So we're going to talk about that. I want to hit something up for the beginners, for the experienced people, because I'll start with the beginners. Let me start again. Okay. There are an awful lot of you who watch this stream who are new. Okay. There are an awful lot of you who watch this live stream who are new investors where you got in at the beginning of the pandemic. You were trading, you were investing, and stocks went crazy. That was maybe a once or twice in a lifetime event to see stocks like DoorDash and Zoom and so many other consumer tech related stocks go up to the extent that they went up. And it was pretty easy to make money. And I had conversations with some of my newbie friends in the market. One of them was so bold as to say, one of my newbie investor friends was so bold at the start of the pandemic because he was doing just so great with his stock picking, and he thought he had it all figured out, and all those people came before him don't know what they're doing. And he actually said to me, "This is a friend of mine, Mitch, maybe you and I should consider partnering up. I mean, together we could really we could be incredible with my picking. And your clients, we could do so amazing well." And I was like thinking to myself, what a newbie. I mean, it's like nothing shouts inexperience um, like hubris. Can you imagine the nerve of somebody saying to me, a fairly new investor, "Hey, we should look. I'm unbelievable. Like this guy thought he figured it out. Like he cracked the code to figure out, like he cracked the code to figure out how to make money consistently and plentifully in the stock market and easily." I just and this went on with a lot of people. A lot of people thought they were really good at this, and a lot of people are probably suffering right now, or a lot of people started gambling. Well, if they didn't realize it, they were gambling, not investing. And when you make money in something, not you specific, I'm talking people in general, they don't know how to walk away from the party, right? We're going to talk a little bit more about that. We're going to talk about some things for experienced investors. Let's put the scroll down here. Let's roll a quick intro. We're going to cover today's market action. We're going to cover some experience. We're going to cover some lessons that you may have learned or you may have missed that would help you going forward. Here we go. If you're just joining us, I'm Mitch Goldberg with Client First Strategy. You're watching my live stream. I call it Be the Boss of Your Money. Makes sense, right? Be the boss of your money. Maybe I should have called it Money Control, Money Center. I don't know. I came up with that. I'm kind of stuck with it. I like it, but sometimes, you're creative, but it's not like I'm creative once. I'm always creative. So I'm always reinventing, the wheel. I'm always tearing down what I invented you know, to reinvent it, to make it better. It's part of the creative process, part of the learning curve. It's part of what I enjoy. I love doing this stuff. All right, so we have a really tough market today, and well, tough. When did all this stuff start? When did we just really get into a tough market? When did the market start to head south? When did we really get into such a tough market? It started last Thanksgiving, the day after Thanksgiving. If you recall, the Dow was down 900 some odd points on the day, and everybody said it's a one hit wonder. Not me. Okay. It's a one hit wonder. They were saying the volume is light. It's only the day after Thanksgiving. People, investors in the market are just consolidating, and they did it on a low volume day. But ever since then, it's been rocky. And why is that? Because right before Thanksgiving is basically when um, investors, at least the early ones to the change in Fed policy, recognize that the Fed is changing its loose money or easy money policy. The Fed's going to start tightening. And as more people came to believe that, the stock market became more volatile, went down more, to the point where we're not really that far from retesting the lows in the stock market that were set a little bit earlier this year. If we get there, some people and we bounce, people call it a double bottom. And if we bounce, it's bullish. If we break through it, we have new lows to set. And you won't know until after it happens. So, what do you do with your money? Okay. If you are investing for the long term, I want you to know that stocks have been considered a good hedge against inflation. Like, stocks can keep ahead of inflation. Why? Because you have management of companies, human beings who make decisions in terms of what to sell, how to package things, where to source the manufacturing, how to distribute, transportation, etc. And there will be some corporate managements who figure out how to thrive in the current economic situation we're in, which is rapidly rising inflation and slowing growth. And some will figure it out. And this is why, if you just put your money into an index fund like the S&P 500, by the way, you cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. But if you put your money into an index, instead of trying to pick the needle in the haystack, what you're really doing is you're buying the entire haystack, expecting that a portion of those stocks will go up substantially, and that will outdo what the a lot of other stocks could do on the downside. So I'm just sharing something with you about investing, all right? And I thought of something really smart before. Maybe it wasn't that smart because I don't remember exactly what I said, but um, there's well, it goes along something like this. There's only so much you could do um, to win in the stock market. Now, we started talking about beginner investors earlier in the show, whereas a lot of beginner investors were starting to think investing was easy. And look at this, I bought DoorDash, I bought Zoom, the stocks people talk about all the time. All right. And look how easy it is. I made money in this, I made money in that. I'm really good at this. I'm really smart. I guess some people don't have what I have. I'm really good at this. All you did was you caught a hot market. You did it a few times. You caught a couple of little winning trades, and your hubris went out of control. Your head just got so big. And making money like that early on in your investing career, because you're staying home, not doing a lot, put your stimulus money in the market, trying to trade for some extra income. You were on chat forums, you were on Reddit, you were trading on Robinhood. And then what happens is you had a few quick winners, and it validated all of the worst things that could possibly be validated for any investor. You started to think you were smart. You didn't just become smarter. We're basically born with our intelligence, and then we have life experiences that carries us the rest of the way that really make us in a way smarter. Okay. I've seen this before. I was in the market, starting in 1990. I became a stockbroker in 1990, and I saw this market, in 98, 99, and early 2000. I saw what happened. I'm not saying I didn't get caught up with it in 99. I thought I was brilliant in 99. Like, I can't believe it. This is too easy. And I was right about that. It was too easy. When the bubble burst, the tech bubble burst, it was a sad day, sad time, rough time in my career, and I had to, recover from that. And I learned such valuable lessons. It's what got me through, though. It's what got me through the Great Recession. People say, "Well, how'd you get through the Great Recession, the bear market of '07 to '09?" Well, I had experience. I learned. The only couple of things you could do to get through a rocky market, a recession, uncertain times, is diversify and give yourself time. That's really about all you can do. I wasn't overly concentrated in the stocks that got wrecked in the market in '08, '09. I didn't buy Lehman Brothers and then buy more Lehman Brothers and then buy more, because what happens is you buy a stock and then it goes down, you buy more, and then it goes down, you buy more. That position becomes so big in your portfolio that if it doesn't recover, you're risking everything. And then what do you do? Do you buy more? Do you wait for it to recover? Do you sell? Once you become overly committed, vested, like psychologically, personally vested in a losing stock, it's impossible to get out of it. This is why I always say to people, stocks are just tools. The S&P 500 index is just a tool. It's just a tool. It's not the end all and be all of risk management, portfolio management, and financial planning. By the way, diversification, that's a strategy that we use. And, it's a strategy. Diversification is a strategy that we use to mitigate downside risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. That's why the S&P 500 is going down in spite of how much it's diversified, 500 companies, right? There's more to know about the S&P 500 than it just has 500 companies. It's a market-weighted index. So bigger companies like Apple and Microsoft will have a bigger weighting in the index than a smaller company like, let's say, General Motors. All right, just so you know. So Apple has a much bigger sway over how the index does than GM. Now you might say, well, that's great. Apple's a great company. Stock always goes up. Well, just keep in mind that Apple almost went bankrupt twice already in its corporate history. And that is not untypical of innovation, where, the thing about innovation is obsolescence, right? So innovation is one side of the technology coin. Obsolescence is the other side of the technology coin. Before the show, I was watching on CNBC. I was watching Kathy Wood she's the fund manager of the ARK fund, ARK Innovation ETF. And, I've said this before, it bears repeating. I don't like when a fund manager becomes a media star. It literally spells doom for the fund when that happens. And this, in her case, it was no different. And she says things like, truth will be discovered, truth will tell, or she says these phrases, but they have nothing to do with portfolio management or security analysis or picking stocks. And she basically picked the momentum stocks of the era into one package. So her fund went up, but just like you bought DoorDash or Zoom, so many other stocks in that space, Peloton, that's what she did. And then when they got wrecked, her fund got wrecked. And then she's, oh no, we in a few years, a couple of years, we'll be back and we'll be better than ever. Then it's like 3 to 5 years, we'll be back. Maybe she'll say in the next 6 to 10 years, we'll be back. If you give yourself enough of a runway, nobody's going to remember what you say today anyway. That's why I don't like when fund managers become stars. It's different fund managers do well at different times in a market cycle. So right now, if you have a fund manager whose focus is on, large cap drug stocks, not biotech, but large cap drug stocks and consumer staples, well, that fund manager is going to be doing very well and outperforming all of his peers who are not doing just that. So, but is it the fund manager, or is it just that manager's style is working in this given environment? Late cycle, we call that, when people start to worry that the economy is going to slow down. They go into companies that could still grow their earnings and revenues consistently, and that typically is growth stocks like drugs and personal care, things like that, consumer staples, food. If you have any questions about this, all right, if you have any questions about this, hit me up in the comments. Hit me up in the comments below. That is the best part of doing this. Words of encouragement, words of wisdom, sharing your experiences. That is always the best part, and I love to hear from you. So please do ask questions if you are brave enough to do so. But don't be shy. I don't bite. Okay, so these are some of the things we talked about. So we're talking about newbie investors who unfortunately were right out of the gate with what they were doing. They were making money quickly, and it validated some really bad things. To me, an investment is buying a stock and waiting for it to work. And I'm not looking to make 40, 50, 80% on a stock, by the way. Just because the stock doubles doesn't mean I automatically sell it. I might sell a little bit of it, but if it's a good company, I'm pretty much holding. I'm holding for the long term. I have stocks in clients' accounts that have gone up by 10 times in value or more. That's really what I'm looking at. I don't think you're going to buy a stock now trading at $3,000 that has a trillion or $2 trillion market cap that is going to go up 10 times in value. Not anytime soon, for sure. Okay. So having said that, it does come to a point where companies just become a solid holding in your portfolio that could meander a little bit higher over time. But that's the key, over time. So what I'm saying to people, and now I want to talk to the experienced investors out there. Okay, so now I want to address the experienced investors out there. If you're investing now and you've seen ups and downs, you could pretty much be confident that you are going to be holding on through a down market. You are holding on through a down market now. There's a really good chance that the down market continues. For example, today we saw the stock market pop in the morning. Pop of the morning to you. I really meant top of the morning, but I'm doing pop in the morning. It doesn't sound that good. So you're really like get back to this morning. Stocks popped like, oh, we're out of the woods. We have a big rebound coming. Inflation figures came out today. They were highest in 40 years, but not quite as high in some of the metrics. The core rate in inflation was a little bit lower than expected. Stocks took off, and by the end of the day, which the Dow is up almost 400 points, it wound up being down almost 100 points, almost a 500-point swing. And for what? This is what a bear market to me looks like, that no matter what the news is, good or bad, it always is interpreted with a negative bias and stocks go down. It's the opposite of a bull market. No matter what kind of news you get in a bull market, news is interpreted as always bullish, always positive, and stocks go up. We're in the opposite. So you know that if you're a long-term holder, you're going to be riding stocks a little bit lower now, maybe a lot lower. And you know that trying to get out now and then getting back in when stocks are even lower is a fool's errand. Because even if you got out now, and it takes a lot of guts to just get out of everything now, and then you think you're going to get into everything earlier, now you're going to become gun shy. Well, why should I get in now? Because the stock market could go lower. And then if it goes lower, it validates your thought process that you should wait for the market to go lower. Eventually the market pops, it recovers, and you say, well, I'm not going to buy it when it just went up when I could have bought it lower. And you just go back and forth, and you procrastinate forever. And then what happens is 5, 10, 20 years later, you look back and you go, that money could have tripled or quadrupled in the time that I was procrastinating. Be an investor. Don't keep staring at the stuff. I say to you, keep investing monthly or investing regularly, or if you just want to put all your money in at the same time, lump sum, just hold on. Now, if you're older, here's where you get to the older crowd, and you need your money coming up, you should have already made the changes to your portfolio to become less aggressive, more conservative, more stable. That's what you should have done that well in advance. Because if you sell your stocks or your ETFs or your mutual funds into a down market, it means the stock market now has to go up even more to offset the losses that you took because of fewer shares working for you. Remember, if you had to sell shares of ETFs or mutual funds, whatever, to take cash out of your portfolio to pay your living expenses, it means you have fewer shares left in the market. So not only did you sell into a down market, but now the shares you sold, the ones that you left remaining in the portfolio, have to go up so high to help you recover from what you just took out of the portfolio. So you need to be making these changes well in advance. And I do speak to boomers who should have known better, who got into this hot stuff. I call it hot stuff, hot stocks during the pandemic. One guy in his retirement community in Florida, he's like, "Oh, we're doing unbelievable. We're doing great. You know, okay. How's it going now?" It's amazing how quickly people could think something is easy when they're validated based on so little data. Just amazes me. So that's basically the story of the day. Let's take it to the tape and let's see if we need to do. Let's take a look at where things close. I'm going to make my screen. I'm going to make my screen a little bigger so when we get there, you can see it for yourself. Okay, here I am. So Dow down 87, Nasdaq down 40, which based on the last couple of trading days, seeing the Dow, Nasdaq, and S&P down fractionally is not such a bad thing, right? Oil, though, big day. Oil up almost 7% to over 100 for West Texas Intermediate. That's a big move. Like I was listening to Kathy Wood again. She's like, "Well, I just saw oil go down, so that's lowering inflation." I don't know if she saw at the end of the day that oil is up over 6%, almost 7%, and maybe it goes even higher now. All right, the VIX was down a drop, but basically flat. All right, let's take a look at bonds. After hitting 3-year highs yesterday, yields did back off a little bit. The 10-year, this is the one we look at the most, was about 2.82, closed at 2.72. But if you look at the ETFs that track bonds, the move was ever so slight. They one fund I track was up like 12 cents. Big deal. Okay, not a major thing. All right, let's take a look at cryptos. Forget this one here. We have to go by this top one. Bitcoin down another 500, solidly under 40,000, and that to me, Bitcoin just trades with the more speculative parts of the stock market. Fed's raising rates. Today's inflation numbers came out really high. That all but puts in a slam dunk for us that the Fed's going to go with a 0.5% increase in Fed funds when it meets. The meeting is May 3rd is when that happens. So today's only the 12th. So we still have a little bit of time to see how better or worse things could get. But it's pretty much a slam dunk that the Fed goes in for half a point rate increase. The next meeting, we're all expecting half a point increase, and maybe the meeting after that. We've got to get inflation under control. All right. And let's take a look at the watch list. Let's talk about some beaten down stocks. That's not what I wanted. Oh, here. This is what I wanted. Beaten down stocks. So these are stocks. These are industrial stocks. Keeping an eye on the time here. We've got a couple minutes left. Wabash National was just, solidly at 20, then 19, then 15, down to 12 and change at its low. This could start to get a little attractive. I don't want to come off like I'm making recommendations, but a lot of these stocks, not Granger, but Honeywell, way off its high. United Rentals way off its high, UAL in the mid range, Boeing way, way, way off its high. That stock was $400 heading into the pandemic, by the way, over 400. Okay. Southwest Airlines, it's not far from it. It hit its low, maybe a month and a half ago. GE, Caterpillar, a lot of these stocks have backed off. So the question is, do you keep? Let me go look at a different sector. Okay, let's look at staples. Then you look at staples, though. Look, Coke at a high, Hershey at a high, Colgate, 81 down from 85, not far. Constellation Brands 258 down to 248, not too far. Mondelez is taking a bit of a hit again from 69 to 63. Not terrible. Inflation worries. Pepsi's not far from its high. For New, I have nothing to do with the stock. Conagra, that's the middle of the range. But a lot of these stocks, look at Church, Kellogg, Church and Dwight, they're still close to their highs. Procter and Gamble, not far from its high. Okay, so the point I'm making to you is, everybody's running into into the consumer staples, into the drug stocks. Johnson and Johnson the other day just hit a new high, all-time high. Does that mean you keep buying the same stocks? I think you have to be a little contrarian and say maybe it's time to take a little profits on some staples, uh, some drug stocks, and maybe either put some money in cash or start to nibble on areas that have been hit and the economically sensitive areas of the market, like material. Well, I shouldn't say materials. So I'm going to say financials and industrials have been hit. So if you're looking for something cheap, that's where you go. Now, a lot of people are afraid to buy into industrials right now, for example, because they want to see if a recession is coming. Are we or are we not going into a recession by either this year or the beginning of 2023? I don't know. The consensus is recession, but there's still a lot of people who are thinking we might skirt out of a recession. We might not quite get 2 quarters of negative GDP. I don't know, and I'm not a fortune teller, but I know how to manage risk and portfolio management. And the thing is, if you're afraid to buy, if you're afraid to buy an industrial stock, a company in the industrial sector, because you're afraid of a recession or it could go lower, then maybe investing isn't for you. I don't know. I just, anytime I buy a stock either for myself or for a client's portfolio, I'm never afraid to buy it because it could go lower, because that's already built in. Like, of course, the stock could go lower after you buy it. This is why I don't take a big bet in a new position. I just buy a little bit and see what happens. Usually stocks do fluctuate, so there's a really good chance a stock could fluctuate a little bit lower just from volatility. But I'm not. But if you're afraid to buy an industrial because you're afraid, oh well, we could go into a recession, we could, and if we go into a recession, these stocks could go lower. Maybe it's already factored in. Maybe we've already factored into the equation a recession coming in the next 9 to 12 months. Factored in, maybe. And if it's factored in, maybe a lot of stocks have gone down low enough to compensate you for the risk. That's all I'm saying. So if you're someone who says, hey, I've got drug stocks and consumer staples that have gone up to such a big portion of my portfolio, maybe you want to rebalance, take some of that off, buy a space that hasn't gone up or that's gotten hit, or at least sit on cash. There's so many ways to skin the cat here. Nothing against cats. There's so many ways to peel the banana. That's a better one, right? There's so many ways here to peel the banana that you don't have to. You don't have to make it overly complicated. All right, just sharing with you some portfolio management expertise. I hope you enjoyed today's show. If you did, please give us a thumbs up or a clap or whatever the reaction is on the platform that you're watching on right now. And if you don't mind, leave a comment, share the episode with a friend. I'd love to grow my audience, and the more people I can reach, the more people I can help. And I will be back tomorrow. Have a good night.